Hi there, it's Mark Sebastian, the founder of OptionPit.com, and this is the Option Pit Frequently Asked Questions. Reminder this for education purposes only, shouldn't be considered investment advice. Options carry some risk. Starting on Thursday is our big Black Friday sale. It's going to be half off everything in our store, which you can find in our courses. And then on Small Business Saturday, we're going to have an extra special deal on our gold membership, which will be very limited in supply. We're going to offer, very few at that special price, and then we're going to offer even fewer on Monday of our platinum level at a crazy inexpensive price. So, go to optionpit.com. You can check things out, and please like and subscribe this YouTube channel. Share, leave a comment, ask me questions. I'll answer your questions for you. So today I want to talk about this article. So this is a article from the Wall Street Journal on Ray Dalio and Bridgewater making a $1.5 billion bet on options. Now, interestingly, I had been called prior to the publishing of this article to consult on a couple of factual pieces on what they were writing. They just wanted to make sure they had everything correct. And one of the things I said, was the way you're kind of presenting this in terms of being an option bet on a falling market is really not correct. And I explained why, and then Ray Dalio came out and basically confirmed my suspicion. So what I thought I would do for today is explain what is Ray Dalio doing and why is the Wall Street Journal piece on Bridgewater incorrect. So I'm going to show you, this is Thinkorswim. They just got bought by Charles Schwab this week. And I'm going to show you a very, very general idea, obviously way less expensive version of what the Bridgewater position looks like. So this is long the March 275 puts in SPY. You can see SPY, as we're recording this, trading about $313.55. And looking at my chart here, I want to show you what the P&L of this position looks like. I'm long 10 of the 275 puts. So if the market drops, what I want you to notice is that, in fact, this position makes a lot of money. All right, the sooner it drops, the more I make and the quicker I make dollars. Right, at $250, so that would be a nice 20% drop in SPY. My 10 lot of puts would be up about $26,000 today, $22,000 at March expiration. And I don't want to throw in any changes in volatility. Let's keep things kind of simple. All right. So this is the way the Wall Street Journal reported the position. So here's the issue, is that Bridgewater is not naked these puts. They have an alternate position against it, which is essentially, and this is again simplified, long SPY. So long SPY for $313, you can see down at $250, I'm losing about $95,000. All right, relative to my, relative to where I'm at now, which is flat. Okay, real simple, right? It's the same thing, right? If I'm long 1,500 shares, which I'm long, every point that SPY loses, I lose $1,500, $1,500. So down 20%, you'd lose, about $100,000 on 1,500 shares. Makes sense, right? So then, what if I combine these two positions? What does this do to my trade? Well, take a look. Now you can see at $250, instead of down $95,000, I'm only down $69,000. And as we drop further, I'm losing less and less. At $200, I'm only lost $97,000, whereas I'd be down about $175,000 at $200 if that happened today. Now, there's an additional component involved here called volatility. And if you're somewhat familiar with the VIX, what we know is that if we drop 20%, the VIX is going to go higher. Well, options are sensitive to increases in volatility. So if the VIX goes up, generally, long options make money. So I'm going to say the VIX goes from 11, where it is, to, let's say, 30. So we're going to raise implied volatility 20 points. So now let's look at my 250 bucks again. So remember, I'm losing 95,000 if I'm naked. Now I'm only losing 59,000 instead of $69,000. So my position is actually doing better. So what is the whole point of this? Well, by having this hedge on, when the market takes that dive, if he thinks the market is going to take that dive, here's what they can do. They then sell their option position. So I would create opposite order. I don't want to analyze an opposite order. All right. But I'm going to sell it at about $75. All right. So now I'm at $225. I am down about 60,000 bucks, and I'm naked long the stock again. But I've pocketed $73,000 that I made from selling my option. So I essentially hedged off a lot of my downside risk. So I can then choose to get new exposure in the market, or if I'm that terrified, I can go in and buy more options. But that is the basics behind what he is doing. The bet, the headline that you read in the Wall Street Journal on the bet that the market's going to fall is incorrect. What it really says is that he's hedged, because here's the important part to remember. If we rally 20% from 313 up to 370, he makes $85,000 on this position. If we drop 20% to that 250, he loses $59,000 on this position. So he still wants the market to go up. He still wants the market to go up. He's just protecting himself and his investors in case the market does fall. And with the S&P at an all-time high, it'd be kind of silly not to, and irresponsible for a good fund manager not to set up a hedge. So that is the real basic, fundamental 8-minute throwdown on what they're trying to do at Bridgewater, and why his statement that we are not, as a whole, in our entirety, making a bet on a short market. We're making a bet on the market going up. And there you have it, folks. All right, again, please like, subscribe, and ask questions to this YouTube channel. And make sure you go to Option Pit on Thursday and Friday for our awesome Black Friday specials. I look forward to talking to you guys soon. Call us 888-TRADE-01 or email me marketoptionpit.com with questions. Have a great day.